Trendlines are one of the most used tools in trading, and also one of the most misunderstood. Most traders just connect 2 points and wait for a bounce. But if you've ever drawn a perfect-looking trend line, only to watch price rip straight through it, you already know something doesn't add up. The truth is, trend lines only work when they're combined with structure, confluence, and confirmation. And that's exactly what I'm going to show you today. In this video, I'm going to break down a simple but powerful trend line trading strategy that most traders completely miss. Here's what you'll learn in this lesson: how to draw trend lines the right way, how to trade using trend lines effectively, how to combine them with confluence for more accurate setups, the trendline bounce strategy, the trendline breakout strategy, and how to apply them across multiple time frames for smarter entries. All right, let's jump straight in. One of the most common questions I get is, how do you actually draw and trade with trend lines the correct way? Let's keep it simple. A trend line is just a line we draw on the chart to connect key swing highs or swing lows when the market is trending. Let's start with a downtrend. Price moves in waves. It drops, then pulls back, then drops again. The lowest point before the pullback is called a swing low, and the highest point before the next drop starts is a swing high. In a strong downtrend, price keeps making lower highs and lower lows. To draw a trend line here, we connect the swing highs across the top. That line becomes a dynamic resistance, meaning price often gets pushed down when it touches it. Now let's flip it and look at an uptrend. Again, price moves in waves, a push up, a small pullback, then another push. The highest point before the pullback is a swing high, and the lowest point before the next move up is a swing low. In a strong uptrend, we see higher highs and higher lows. To draw a trend line here, we connect the swing lows across the bottom. That gives us a dynamic support line. Price often bounces from it when touched. But here's something important. Real markets aren't always this clean. Price doesn't move in perfect waves, and trend lines won't always look exact. Still, this structure helps us understand how price moves and where to look for trades. So, why do we draw trend lines at all? There are 2 big reasons. First, trend lines act like support and resistance. In an uptrend, the trend line acts as support. Price often bounces upward when it touches. In a downtrend, it acts as resistance. Price often gets rejected and moves down, but don't make the mistake of entering a trade just because price touches a trend line. You always need to wait for confirmation, and I'll explain that part later. Second, we use trend lines to spot possible trend reversals. In a downtrend, the trend line sits above the price. If price breaks above that line, it could be the first sign of a shift to an uptrend. In an uptrend, the trend line is below the price. If price breaks below the line, it might mean the uptrend is ending, and a downtrend could begin. But here's the thing, just because price breaks a trend line doesn't mean the trend has reversed. It's not a guaranteed signal. You still need extra confirmation, and I'll show you exactly how to get that in the next part. Now that you understand what trend lines are and why they matter, let's talk about how to draw them the right way so they actually improve your trading. Before we start placing trend lines on the chart, there are a few important rules to follow. First, you need at least 2 touches to draw a valid trend line. If price touches the line 3 or more times, it gets stronger. But keep in mind, more touches don't guarantee the line will hold forever. Markets are rarely smooth and perfect. Most of the time, price action is messy, choppy, and unpredictable. So don't expect the market to respect your line perfectly every time. Look at this example. Price broke below the trend line, but then closed back above it. That's a fake out. Here's another one. Price just sliced straight through the line. No respect at all. That's why we say, treat trend lines as zones, not exact lines. They're guides, not hard rules. Think of them like flexible areas where price might react, not where it must bounce. Check this out. Price bounced even before touching the trend line here. Same thing happened again right here. This proves that trend lines are not precise levels, and that's totally normal. Still, as a trader, it's your job to draw the best line you can, stay consistent, and stay disciplined. Now look at this spot. Price pulls back, retests the trend line, gets rejected, and pushes upward. That's a clean reaction and a high probability opportunity, but here's something traders often get wrong. Don't force trend lines. If the trend line is obvious and it makes sense with the chart structure, draw it. But if the market is unclear or choppy and you're struggling to place a line that fits, just leave it out. Here's an example. See this trend line? We forced it. It looks okay at first glance, but we ignored this key touch here, and that's a mistake. Here's another one. We're trying to make the trend line fit, but the structure just isn't there. Instead, follow the real price movement, not what you want to see. Okay, now let's talk about one of the most common questions traders ask. Should I draw my trend line through the wicks, the candle bodies, or both? Here's the answer. Always draw your trend line wherever you get the most valid touches. Let's walk through an example. Here's a clear downtrend on the chart. Now watch this. When I draw a trend line that lines up with the most swing points, you'll see it touches both wicks and candle bodies. In some spots, it connects right at the end of the wicks. In others, it cuts through a wick but touches a candle body instead, and that's okay. The goal is to get the most valid touches, not to be perfect. That's the key takeaway here. Your trend line should hit as many relevant points as possible. Now look at this next example. Here we're in an uptrend, so we're connecting the swing lows, same logic. This trend line touches wicks, candle bodies, or a mix, as long as it gets multiple clean connections. So don't overthink it. Trend lines are tools, not rules. They're meant to guide your analysis, not force your trades. Now that you know how to draw trend lines correctly, let's take it a step further. I'll show you how to combine trend lines with price action to find high probability trade setups. But real quick, if you're finding this helpful, tap that like button and drop a comment below with any questions or topic requests. Your feedback really helps shape future videos. All right, let's move on. We use trend lines and price action together in two main ways. First, we use them for trend continuation, which means trading with the direction of the current trend. Second, we use them for spotting potential reversals, places where the trend might be changing direction. Let's begin with trend trading. One of the best ways to trade with trend lines is to look for areas where trend line support or resistance lines up with another key level. This is what we call a high confluence zone. A confluence zone is where multiple signals agree, maybe a trend line, a horizontal level, or a supply and demand zone. When they line up, that area becomes highly watched by many traders, and that's important because when lots of traders are watching the same area, you often get stronger reactions from price. All right, let's go through a real chart example to see how trend traders use trend lines and confluence to find high probability trade setups. First, we start by identifying the overall trend. If the price is making lower highs and lower lows, we're clearly in a downtrend, so we'll only look for short trades. If it's making higher highs and higher lows, that's an uptrend, and we'll be focusing on long trades. In this case, the chart is showing a downtrend, so we're only interested in sell opportunities. Next, we draw our trend line by connecting at least two swing highs. We extend that trend line into the future because it may act as a dynamic resistance if price pulls back. Now, look to the left side of the chart. You'll notice a support level that price previously broke. Once that support is broken, it can turn into resistance. We mark that area as a key level. Now, here's where it gets interesting. Look at the point where the trend line and that horizontal resistance meet. That's our confluence zone, where two key factors line up. This is a spot many traders will be watching. It could lead to a strong reaction from sellers, but hold up, we're not entering a trade just yet. We never enter just because price touches a level. We wait for price action confirmation. You might be wondering, if this is such a strong area, why not sell as soon as price hits it? Here's why. Price can still break through. Just because an area looks strong doesn't mean it will hold. And that's why confirmation is everything. Now, watch this. As price reaches the confluence zone, we start to observe, you can see a bearish reaction, 2 red candles rejecting from that level. That's a good sign, but it's still not enough to enter. A reaction is just the first clue. It doesn't confirm a full reversal yet. Many traders jump in too early at this stage and then get stopped out when price breaks the level anyway. We need one more layer of confirmation, and I'll show you in the next step. Here's a simple trick. To confirm the trade setup, draw a short-term trend line over the pullback, that small upward move, then wait for that mini trend line to break before entering. Why is this important? Because while the bigger picture is bearish, the short-term pullback is still bullish. If that short-term bullish move keeps going, it could break through the confluence zone and flip the entire trend. That's why we wait for the break of the short-term trend line to confirm that sellers are back in control and the downtrend is resuming. Now that we've covered downtrends, let's flip it around and talk about how to trade an uptrend using trend lines and price action. Before anything else, we need to confirm we're in an uptrend, and the definition is simple. Price is making higher highs and higher lows. Each pullback doesn't break the previous low. Instead, price just keeps pushing upward. Once we see that pattern, we know it's time to focus on buying opportunities. Now, let's draw our trend line. We connect the swing lows, drawing the trend line below price. This trend line acts as a support level, and when price pulls back to it, we're looking for a possible bounce. But don't stop there. We don't want to buy just because price hits the line. We want to find confluence, a spot where multiple signals align. So look to the left side of the chart, find an old resistance level that's now acting as support. If that horizontal support aligns with your trend line, that's a high confluence zone. These areas are powerful. Support and resistance traders, trendline traders, price action traders, they're all watching that same level. And when many traders are watching the same thing, we get stronger reactions and clearer trades. Now comes the best part, waiting for price to come back down to the trend line. But here's the key. Don't enter just because price touches the line. Wait for confirmation. So, what does confirmation look like? It could be a bullish rejection candle, like a pin bar with a long wick, multiple failed attempts to break below the line, or a strong bullish momentum candle pushing up from support. In this example, we see a rejection wick. That tells us buyers are stepping in, a strong buy signal. Now, here's another smart trick. As price is pulling back, it often forms a mini downtrend. Draw a short-term trend line over that pullback, then wait for a break above that line. That adds even more confirmation that the move is turning around. But again, this part is optional. If you're a conservative trader, wait for that extra break. If you're more aggressive, like me, you might enter right after the price action signal. Yes, sometimes the trade hits stop loss, but in the long run, when you're trading with the main trend, the wins outweigh the losses, and the risk to reward is worth it. Now that we've covered how to draw trend lines, how to find confluence, and how to use price action confirmation. Let's put it all together with one of the most powerful setups, the Trendline Bounce Strategy. This is a trend-following strategy. We're trading in the direction of the current trend using trendline support or resistance as the base. Let's walk through two real examples, one in an uptrend, one in a downtrend. Example 1. Uptrend. Look at this chart, clear uptrend with higher highs and higher lows. We draw our trend line along the swing lows. Price pulls back and touches the trend line, but instead of bouncing right away, it briefly breaks below the line, then closes strongly back above. Right after that, we see a bullish engulfing candle. That shows buyers are stepping in with strength. Here's what makes this setup so powerful. Traders who bought too early got stopped out. Traders who thought it was a breakout to the downside entered short, but the market reversed sharply, trapping both groups. That's called a liquidity sweep, and it's a big clue that the pullback is over. Now, since we're on the 5-minute chart, we zoom out to the 1-hour chart for confirmation. On the hourly, we see the market is in a range, and price performed a liquidity sweep at support. That's extra confidence. Buyers from the higher time frame are also likely to push price up. Now we've got high confluence. Across time frames, entry, at the close of the engulfing candle, stop loss, below the low of that candle, target, the next resistance level, aiming for at least 2-to-1 reward to risk. Example 2, downtrend. Now look at this downtrend. Clear structure with lower highs and lower lows. We draw our trend line across the swing highs. Price pulls back and touches the trend line again. And right there, we get a bearish pin bar. That's a strong rejection. The wick shows that buyers tried to push higher, but failed. Sellers took control again. Same process. Zoom out to the hourly chart. And what do we see? A double top pattern, a liquidity sweep at resistance. That confirms sellers are likely stepping in on the higher time frame as well. Entry at the close of the bearish pin bar, stop loss, above the rejection wick target, next support zone, again aiming for 2-to-1 or better. This strategy works incredibly well because it trades with the trend, uses liquidity traps, combines multiple confirmations, and gives you high risk to reward setups. Even if a few trades hit stop loss, your winning trades can make up for it easily. This is one of the most reliable ways to trade using trend lines. Alright traders, now that we've mastered the trendline bounce strategy, let's switch gears and talk about something just as powerful, the trendline breakout strategy, a way to catch trend reversals early before the big moves happen. This is where we flip the script. Instead of trading with the trend, we're looking for when the trend is about to change. But here's a big mistake most traders make. They see a breakout and they jump in too fast, only to get faked out, stopped out, and confused. We're not doing that. Instead, we're going to do it the right way with confirmation. Let's walk through it step by step. Example 1, bearish breakout setup. Look at this chart. The market is trending up. So we draw a trend line under the price, connecting the swing lows. Then something changes. Price fails to make a new high and starts forming lower highs. That's your first clue that momentum is slowing down. Then, boom, price breaks below the trend line. That's your signal that sellers may be taking control. This is where we start thinking about a short trade. Example 2, bullish breakout setup. Now look at this one. The market is trending down, so we draw the trend line above price, connecting the swing highs. Suddenly price fails to make a new low and starts forming higher lows. Then it breaks above the trend line. That's a sign that buyers are stepping in, and a possible long opportunity is forming. But here's the key. A trend line break by itself isn't enough. We need extra confirmation to avoid false breakouts. One strong confirmation is a double rejection pattern. like a double top or double bottom forming right before the breakout. Back to the first example. The market was trending up, but then it formed a double top. That's a clear signal that buyers are struggling. Then price breaks below the trend line. Now we have two confirmations, momentum loss and trend line break. That's a strong sell setup. In the bullish example, the market was trending down, but formed a double bottom. Buyers started defending the level, then price breaks above the trend line. That's a high probability buy setup. Waiting for that second layer of confirmation keeps us out of fake breakouts and helps us catch the real ones. But we're not done yet. There's one more important layer, multiple time frame analysis. Let me show you how this works with a real example. Here's a 5-minute Euro US dollar chart. We've drawn a clean trend line under the price. The market has been trending up, then price breaks below the trend line. Now, before we jump into a short, let's double check what else is happening. Look just above the break. There's a double top and a liquidity sweep. Price popped above a level, triggered stops, then dropped back down. This is a classic fake breakout trap designed to grab liquidity and reverse direction. So we've got a strong signal here. But let's zoom out to the 1-hour chart. On the hourly, the trend line is also broken. We see another liquidity sweep at the same double top zone, but here's the real confirmation. We spot a clear order block that's been broken, and now it's acting as a breaker block. Price retests it, and look at this candle. A massive bearish engulfing. That's strong momentum. Now we go back to the 5-minute chart. Since both time frames agree, we've got alignment confirmation and structure. This is the type of setup we want to trade. Entry on the close of the bearish candle that confirmed the rejection stop loss, just above the wick of that candle. Target, next key support level, aim for at least a 2-to-1 reward to risk ratio. By combining trend line structure, liquidity sweeps engulfing candles, and higher time frame confirmation, this becomes a high probability setup. Stick to the process, trust the plan, and let the market do the work. Now let's talk about one final layer that takes this to the next level, top-down analysis. This is key if you want your trades to match the overall market context, whether you're scalping, day trading, or swing trading. Here's how it works. If you're trading the 5-minute or 15-minute chart, use the 1-hour chart as your higher time frame. If you're trading on the hourly chart, your higher time frame is the daily chart. For swing traders using the 4-hour chart, the higher frame is the weekly chart. And if you're trading the daily, zoom out to the monthly to spot long-term trends. This structure helps you align your entries with the bigger picture, which gives your trade a higher chance of success. That's it for this lesson. Now you know how to draw trend lines the right way, trade bounces and breakouts, use price action for confirmation, avoid false signals, and align trades with multiple time frames. Apply this strategy with patience and discipline, and your trading decisions will become way more confident and consistent. We use TradingView.com charts in this video for live examples. This video is only for educational purposes.